Hi, Accounting One. My name is Professor Mary Clay, and I will be your professor for this online Accounting One class. This is an introductory accounting class. So this first PowerPoint is going to be extremely important. So I want you to get your notebook ready, a pen or a pencil, and please take notes. Okay, let's go on to our first slide. These are the rules of debit and credit. These rules were created around 1400 and have not changed since that time. They are extremely important for accounting. So when you learned to write English, you learned an alphabet. Same thing for accounting. In order to make a journal entry, and the only way that dollar values get into an accounting system is by making a journal entry. So in order to make a journal entry, you have to memorize debit and credit. Okay, so let me begin with, you will either debit an account or credit an account. Okay? So if you debit one account, you will credit another. All right, so let's look at the rules. First off, there are 5 main elements. There's assets, liabilities, stockholders' equity, revenue, expenses. Let's start with assets. So I always tell my accounting students to only know the increase side. When you only know the increase side, you will also know the normal balance. So the normal balance of any account is always the side you increase with. All right, so let's test that out. Assets. To increase, you will always debit. The normal balance is a debit. Assets. When you decrease, so the opposite, you will credit. Okay, let's test liabilities. Liabilities. Whenever you increase any liability, you will credit. The normal balance is a credit. The other side, when you decrease, is a debit. Stockholders' equity. When you increase, you will credit. The normal balance is a credit. When you decrease stockholders' equity, you will debit. Okay, so please jot down all of these. And let's look at some similarities, even though they're completely different. Assets and expenses are the same exact way. So watch, whenever you increase any asset or any expense, you will debit. The normal balance is a debit. Whenever you decrease assets or expenses, you will credit. Let's look at the 3 that are exactly the same. Liabilities, stockholders' equity, revenue. Even though they are completely different, I'll talk about that in a different slide. Let's just get rules debit and credit first. Liabilities, stockholders' equity, revenue. Whenever you increase in those areas, you will credit. The normal balance of those 3 different elements are credits. When you decrease any one of those elements, you will debit. So please make up note cards. Don't make this more difficult than it is. Memorize it. I promise you, I'll teach you how to understand other areas of accounting, not this. Just memorize it. Okay, we're going to move on now. All right, so let's talk about what is accounting. Accounting is a process where financial activities are organized, recorded, and analyzed. So really, the most important part of an accountant's job, the higher level, is analysis. So they have to determine what happened with this area. How could we improve it? What caused the change? But in order to analyze, the lower level are organizing and recording. Why is accounting known as the language of business? Simply because it's going to communicate. It's going to communicate via financial statements, which I'll talk about in a later slide, how a company is doing. It's going to communicate to insiders such as managers or employees. Internal auditors are going to look at inside information. It's going to communicate to outsiders as well. Investors, external auditors on the outside, can communicate to a bank. So if a company, a small business needs a loan, the bank is going to require financial statements. They're not just going to lend money to any business without a business plan or financial statements so that they can determine whether they will get paid back or not. Accounting, you should use it. You should use accounting in your everyday life. How? You're going to verify bills. You're going to make sure that what you're being billed on is correct. You're going to pay your bills on time. You're going to complete your bank reconciliation to make sure the bank hasn't made a mistake or you've made a mistake. You're going to watch your money. Businesses use accounting in the same way. They're going to track hours worked for employees to make sure that they're paying enough or that they're not overpaying them. They're going to keep track of their receipts and payments of orders. They're going to keep track of their assets. They're going to make sure that they're fixed assets. So if an employee works from home, for example, and is allowed to use a laptop computer that is owned by the business, they are going to want to keep track of that so they do not lose that computer. They're going to keep track of their revenue and expenses. Very important. We'll talk about that later. There's many different areas that accountants work. Accountants can work in public accounting. Public accounting is going to do taxes. They're going to maybe do bookkeeping. They will offer consulting services so they could compile financial statements. Many different areas that they can do in public. There's management accounting, governmental accounting. There's auditors. Auditors are going to be internal as well as external. There's forensic accounting, deciphering how a fraud was committed. There's tax accounting. The IRS is just going to be hiring a lot of different auditors for their service. International accounting, not-for-profit accounting. The bottom line is everyone needs an accountant to watch the money, to make sure that everything is correct, everything is not fraudulent. Okay, so now we're going to move on. Write these down. Please know these 5 main elements. Yes, I already discussed them. I'm going to discuss them again. So within accounting, there are 5 main elements. Within accounting, the financial statements will decipher the different areas of these elements. Within accounting, account names will fall under these 5 different elements. Here they are: asset, liability, equity, revenue, expense. I will go through these in other slides. We're going to move on. Okay, so every single business is going to have their own chart of accounts. A chart of accounts is a list of all the accounts found in a general ledger. So it's going to list all the different account names that this particular business has. So to set up a chart of accounts, a business would first need to define the various accounts to be used by the business. Each account should have a number to identify it. So the next slide is just a simple analysis of a chart of accounts. So here's just a basic example. You could have asset accounts, for example, from 1,000 to 1,999. So less than 2,000 will be asset accounts. The next category would be the next element. You could have account numbers from 2,000 to 2,999. Those would be liability accounts. You would continue on for the different elements. So when a journal entry is made, they would include this account number, for example, for revenue accounts. So within the number 4,000 to 4,099, they could include any account number under revenue within that category. All right, now we're going to get more particular about the elements. So I'm going to start with assets. So please take good notes. The main element is assets. So within that element, you're going to have different account names. What is the definition of an asset? All right, assets. They represent probable future economic benefits and arise as the result of past transactions or events. So assets are going to help the company make a profit. So yes, I have account names, but let's talk about a landscaper. What would be assets for a landscaper? Well, assets for a landscaper would be trucks, would be a lawnmower, would be shovels, would be rakes. Those are going to help that landscaper make profit for his or her business. The account name examples that will go under assets are cash, supplies, merchandise inventory, land, buildings, account receivable, prepaid expenses, equipment. I don't want to bombard you too much this week. Of course, there are more, but I want to start out slowly. So please take notes on what those particular account names that would appear under assets. Okay, now we're going to go to the next category, which is liabilities. So what are liabilities? Liabilities you can sum up in one word: debts. Just like us, businesses have debts. So liabilities are debts for the business. They are money that is owed to people outside the business. Please write this down. Any account name ending in the word payable is a liability. Here are account name examples that will appear under liabilities: accounts payable, note payable, salary payable, long-term debt. Please write this one down. A lot of times students get this one wrong. Unearned revenue. That is not revenue. Unearned, underline the word unearned, revenue is a liability. Okay? We're going to move on. We're going to go to the next category. So here's the third category: equity. It's also known as owner's equity or capital for a sole proprietorship or a partnership. But at Worcester State University, we are going to work with corporations. So equity for our class will be known as stockholders' equity. Equity is going to represent the owner's claims on assets. So one more time, equity will represent the owner's claims on assets. We just went over liabilities. Liabilities are the creditor's claims on assets. But equity represents the owner's claims on assets. It's also sometimes called net assets. So net assets are known as assets minus liabilities will equal your net assets. Account names for Accounting I, so this is an introductory class. We will learn more as we move up in different levels in accounting. But for the introductory, retained earnings and common stock will be under equity. I will talk about an account name called dividends in a later slide, but please know that under stockholders' equity, for your final balance sheet, I will never see dividends. Okay? All right, just remember that. We're going to move on. All right, now we're going to talk about the fourth main element, revenues. So what are revenues? Revenues are inflows of assets, or not until Chapter 3, reductions in liabilities in exchange for providing merchandise or services to customers. So, in the example of an accountant, that accounting firm would earn revenue by completing a tax return. They would earn revenue by completing bookkeeping services. They would earn revenue by consulting, so providing advice to a client. Same thing for a law firm. They would earn revenue by providing services, such as they represent a client in court. That would be revenue to that law firm. How does Home Depot, how does Walmart earn revenue? They sell merchandise to customers. So when we go through and we purchase our merchandise and the item is scanned, Walmart or Home Depot has earned revenue. So account names that would appear under revenue are service revenue, rent revenue, sales, interest revenue, or just revenue will be under the revenue category, the revenue element. Okay, so those are the 5 main elements. Please take good notes on that. All right, we're going to move on now. Oops. Those are the 4 main elements. Just kidding. All right, so the last main element is expenses. So this is the 5th main element. Expenses occur when resources are consumed in order to generate revenue. Expenses are the cost of running a business. So I always tell my students, think of your own expenses. What do you have for expenses? Well, you're commuting to school. So if you're commuting online, what do you have for expenses? Well, you have your internet expense. You have, you're not only going to leave your house, so you have a car. You maintain that car, you go to Jiffy Lube, you get gas for your car, you need to buy online software. That's an expense to you. All right, let's look at expenses for a business. Well, they also have gas expense. They have cost of goods sold. Please write that one down. A lot of times students forget that one. Cost of goods sold is an expense. What is that? So for Walmart, the cost of goods sold is the cost of that product. It's what that costs them to purchase that product. That is the cost of goods sold. So cost of goods sold is always an expense. Rent expense. So if they rent a building that they're working out of. Salaries. So employees are an expense. A lot of times students think employees are an asset. Employees' salaries are an expense. Wage expense. Insurance expense. Electricity to keep the building lights on, to keep the building warm. Utilities expense. And depreciation expense. There are more, but again, I do not want to bombard you this week. Now we're going to go over the financial statements. Please write the proper order to complete them. Okay, so you will always complete your income statement first. That's going to tell you whether you have a profit or loss. I'll go through that in a minute. Second, you will complete your statement of retained earnings. And lastly, you will complete your balance sheet. The balance sheet is always known as the basic accounting equation. So at Worcester State University, we will cover the cash flow statement in your next level of accounting. Here is how you compute the basic accounting equation. The basic accounting equation will always be assets equal liabilities plus stockholders' equity. Okay, so let's look at an example. So it's a basic accounting equation. If assets are 100,000, so assets 100,000 equals liabilities of 20 plus X. Well, what is your X? 20 plus 80,000 will be your stockholders' equity. So your stockholders' equity in number 1 is 80,000. Number 2, if assets are blank, what are your liabilities plus stockholders' equity? So liabilities are 60, your stockholders' equity is 120. So the sum of those two is $180,000. Okay? So your answer to number 2 is 180. Let's go over the income statement. The income statement is going to tell you whether your company had a net income or a net loss. That's the bottom line of an income statement. It's going to tell you whether your company had a net income or a net loss. Remember this when you're working in the lab. Be careful of the date, or you will be marked wrong. So why? The income statement is only used for a period of time. It is not a year-to-date financial statement. So, for example, when you're choosing the date, if it's ending on July 31st and it's for the month, you will pick for the month ended July 31st. Or if it's for the year, you will choose for the year ended July 31st. Do not just choose July 31st. So you have to be clear on what the exact date is. Remember, it is not a year-to-date financial statement. Write down the basic elements of an income statement. So I always say to students, just write down the basic elements and then we'll work from this more later on. What's on an income statement? All revenue accounts minus all expense accounts will equal your net income, or unfortunately, you could have a net loss. So if your revenue is higher than your expenses, you will have a net income. If your revenue is less than your expenses, you will have a net loss. Let's go over the next financial statement. So the next financial statement is the statement of retained earnings. On this statement, it's going to tell you what happened to the retained earnings account. You will always start with a beginning balance. So you will always start with a beginning retained earnings balance. If you didn't, so for example, if you did not have a beginning retained earnings balance from the year before, you are a brand new business. So that is the only way you would not start with a beginning retained earnings balance if it's a brand new business. Okay, so you're always going to start with a beginning retained earnings balance. It will be the prior retained earnings balance of the balance sheet. So the prior year's ending balance sheet will be your beginning retained earnings for the new year. You will add in your net income. This is why you have to do the income statement first. It's going to flow right down to the statement of retained earnings. So you will always add in your net income. If you had a net loss, you would subtract it. But if you have a net income, you will add it. If you have cash dividends, you will subtract that. So cash dividends will be subtracted from your statement of retained earnings. And then finally, you will come down to your retained earnings balance. I'm going to quickly tell you what cash dividends are. Cash dividends are dividends that are paid out to stockholders. So stockholders are owners of the business. How do they own a business? They purchase common stock of that business. And then that business, for example, say it's Advanced Micro Devices, they pay out a dividend to stockholders. That dividend will be subtracted from retained earnings. So that's taking that money out of the business. You will come down to a final balance for retained earnings. This balance, this final balance, will flow into the balance sheet under stockholders' equity. Specifically, the account name is retained earnings. So again, just write the shell. Here's the shell. Beginning retained earnings plus net income minus dividends equals final retained earnings. So the account name is retained earnings. Also be careful of the date when you work in the lab. Why? Just like the income statement, it is only used for one period. All the accounts on here are not year to date. There is one account that's year to date, and that is retained earnings, but your net income and your dividends are only used for one period. So the statement of retained earnings, the financial statement, is only used for one period. Be careful of the date. All right, balance sheets. Remember, this is the basic accounting equation. Assets equal liabilities plus owner's equity. This is going to be a picture of a company's financial statement. So it's going to be a picture of a company's cash, their year-to-date for cash at that point in time. It's a photograph of a firm's assets together with its liability and stockholders' equity at a specific point in time. And again, it's going to follow the basic accounting equation. Let's look at the next slide. Here's the main elements. Assets equal liabilities plus stockholders' equity. All assets will go on your balance sheet and you will get a total. All liabilities will go on your balance sheet and you will get a total. All stockholders' equity will go on a balance sheet and you will get a total. Your total assets must always equal your total liabilities plus stockholders' equity. Be careful of the date. Why? The balance sheet is a year-to-date financial statement, so you will not choose for the year ended. You will just choose the date, July 31st, 2000 XX. You will always end it on that last date because it is a year-to-date financial statement. Okay, I am going to end it there. Please, if you have any questions, I'm here for you. Yes, an online class, you have to be self-motivated. You have to watch my videos. You have to read and take notes on my PowerPoints. But if you have any questions, email me. I promise you I'll get back to you as quickly as I can. So I'm here for you, and I will see you soon.